Hey there, savvy investors, ready to unlock the secrets of wealth building? Today we're diving into 4 top investments that could set you on the path to riches. Before we get started, smash that like button and share this video. It really helps the channel out. Now let's kick things off with a quick question. What's holding you back from financial freedom? Drop your answer in the comments below. All right, let's get stuck in. We're about to explore 4 investment strategies that could turn your financial life around. These aren't get-rich-quick schemes. This is about building lasting wealth. Have you ever felt like you've missed the boat on a great investment opportunity? Like everyone else knew the secret but you? Well, not anymore. We're going to change that today. These 4 investments are primed for growth. The name of the game is compound growth. So, are you ready to learn how to build wealth without relying on lady luck? Let's go. Let's kick things off with a bang by talking about one of my favorite investment vehicles, exchange-traded funds, or ETFs for short. Now, you might be thinking, ETFs sound complicated. Trust me, they're anything but. ETFs are like the Swiss Army knives of investing, versatile, efficient, and perfect for beginners and pros alike. They're designed to make investing accessible and straightforward, no matter your experience level. Imagine a shopping basket filled with various groceries. Now replace those groceries with stocks from different companies. That's essentially what an ETF is. A basket of stocks you can buy in one go. Pretty simple, right? This basket approach offers instant diversification. You're not putting all your eggs in one basket, which can help manage risk. And believe me, in the world of investing, managing risk is absolutely crucial. Now, you might be wondering, why is diversification so important? Well, let me tell you, my friends, diversification is like having a financial safety net. It's about spreading your investments across different asset classes, sectors, and geographies to reduce the impact of any single investment on your overall portfolio. Think of it like this. You wouldn't want to put all your money into one single stock, because if that stock plummets, you're in trouble. But with ETFs, you're instantly invested in a whole bunch of stocks, which spreads out your risk. This means that even if one company in the ETF isn't doing so hot, the others can help cushion the blow. And the best part is, ETFs make diversification incredibly easy. You don't need to go out and buy dozens or even hundreds of individual stocks. You can achieve instant diversification with just a single ETF trade. It's like magic, but with money. Plus, ETFs are typically low cost and easy to trade. They typically have lower expense ratios compared to actively managed mutual funds, which means more money stays in your pocket. Ready to jump into the world of ETFs? Let's look at some popular options to get you started. One of my all-time favorites is the Spider S&P 500 ETF, also known by its ticker symbol SPY. This bad boy tracks the S&P 500 index, which is made up of 500 of the largest publicly traded companies in the US. Talk about a powerhouse. You're essentially investing in a slice of the entire US stock market with just one ETF. Another popular choice is the Vanguard Total Stock Market ETF, or VTI. This ETF casts an even wider net, tracking the performance of the entire US stock market, including small, mid, and large cap companies. And if you're looking for exposure to the tech sector, the Invesco QQQ Trust, or QQQ, is a great option. This ETF tracks the performance of the Nasdaq 100 index, which is heavily weighted towards technology giants. But here's the kicker, ETFs aren't just for stocks. Nope, they've got something for everyone. You can find ETFs for bonds, commodities, real estate, and even specific sectors like technology or healthcare. Want to invest in real estate without dealing with tenants and leaky faucets? There's a REIT ETF for that. Want to ride the wave of clean energy? There's a renewable energy ETF for that too. It's like having a buffet of investment options at your fingertips, all neatly packaged in these convenient, low-cost ETFs. So which ETF tickles your fancy? Let me know in the comments below. All right, folks, now that we've covered the awesomeness of ETFs, let's move on to another fantastic investment option. Index funds. Now, if ETFs are the Swiss Army knives of investing, think of index funds as the sturdy, reliable workhorses. Index funds are mutual funds designed to mirror the performance of a specific market index, like the S&P 500. They're like the trusty steeds of the investing world, steadily plodding along and delivering consistent returns over the long haul. They're passive investments, which means less work for fund managers and lower fees for you. That's right, lower fees. And we all know that lower fees mean more money in your pocket. Win-win, right? Now, you might be wondering, if they're just copying the market, how can they possibly be a good investment? Well, my friend, that's the beauty of it. Over the long term, the market tends to go up. And by simply tracking the market, index funds are able to capture those gains. Even the Oracle of Omaha himself, Warren Buffett, is a huge fan of index funds. This guy knows a thing or two about investing, and he's consistently advocated for the power of low-cost index fund investing. In fact, he was so confident in the ability of index funds to outperform actively managed funds that he made $1 million bet. That's right, a cool $1 million. Buffett wagered that an S&P 500 index fund would outperform a collection of hedge funds over a 10-year period. And guess what? He won. The index fund absolutely crushed the competition, proving that sometimes simplicity is key. This goes to show that you don't need to be a Wall Street wizard or have a crystal ball to be a successful investor. Sometimes the best approach is to keep it simple and let the market do its thing. So you're ready to harness the power of index funds? Let's look at some popular options to get you started. First up, we've got the Vanguard 500 Index Fund, or VFIX. This bad boy is a classic choice for a reason. It tracks the S&P 500 index, providing broad exposure to the US stock market at a super low cost. You really can't go wrong with this one. Another solid option is the Fidelity Zero Large Cap Index, or FNRLX. This index fund also tracks the S&P 500, but with a twist. It has zero expense ratio. That's right, you heard me correctly. Zero fees. Fidelity is literally giving you this index fund for free. And last but not least, we have the Schwab S&P 500 Index Fund, or SWPPX. This is another great low-cost option for tracking the S&P 500. Remember, the key with index funds is patience. They're not get-rich-quick schemes, but rather a way to steadily build wealth over time. All right, smart money movers, let's dive into the world of real estate, but with a twist. Ever dreamt of owning a skyscraper or a shopping mall? REITs can make that dream a reality, or at least a smaller scale version of it, without the headaches of being a landlord. We're talking about owning a piece of those massive buildings without having to fix a leaky faucet at 3 a.m. REITs are like the superheroes of passive income, generating a steady stream of cash flow from rent payments and property appreciation. Now, imagine collecting rent checks from hundreds, even thousands of tenants without ever having to chase them down. That's the beauty of REITs. They pool money from multiple investors to buy and manage income-generating properties, giving you a slice of the real estate pie without the usual hassles. Plus, REITs are legally required to distribute at least 90% of their taxable income to shareholders as dividends. Yes, you heard that right. It's like having a steady stream of rental income flowing into your account quarter after quarter without lifting a finger. Section 2, Prologis, the king of warehouses. First up on our REIT roster, we have a titan of the industrial real estate world, Prologis. These guys are like the Amazon of warehouses, owning and operating a massive network of logistics facilities across the globe. Think massive distribution centers, warehouses, and fulfillment centers that keep the global supply chain humming. With the rise of e-commerce and the ever-increasing demand for faster deliveries, Prologis is strategically positioned to benefit from this global logistics boom. They're like the landlords of the internet, and their properties are in high demand, which translates to steady cash flow and potential for long-term growth. Now, you might be thinking, warehouses, really? But trust me, these aren't your grandpa's dusty old storage units. These are state-of-the-art facilities that are crucial for businesses of all sizes, from small startups to Fortune 500 giants. And as more and more businesses move their operations online, the demand for these logistics hubs is only going to skyrocket, making Prologis a potentially lucrative long-term investment for those seeking exposure to the booming e-commerce sector. Next up, we have a REIT that's all about consistency and reliability, Realty Income. They're like the gold standard of REITs, known for their impressive track record of paying monthly dividends. Yes, you heard that right, monthly. They own a diversified portfolio of over 12,000 commercial properties across the United States, leased to a wide range of tenants, including grocery stores, drugstores, and convenience stores. These are businesses that are essential to our daily lives, making Realty Income's portfolio resilient to economic downturns. Now imagine receiving a dividend check every single month like clockwork. It's like having a second paycheck, providing a steady stream of passive income that can help you achieve your financial goals faster. And with their long history of dividend growth, Realty Income is a favorite among income investors seeking reliable cash flow and potential for long-term capital appreciation. Last but not least, let's talk about REIT that's riding the wave of the future, American Tower. These guys own and operate a vast network of cell towers across the globe, providing the critical infrastructure for our increasingly connected world. With the rollout of 5G and the ever-growing demand for mobile data, American Tower is strategically positioned to capitalize on this technological revolution. Their cell towers are like digital real estate, and they're only becoming more valuable as our reliance on mobile devices continues to soar. Now, think about how much you rely on your smartphone every single day. From making calls and sending texts, to browsing the web and streaming videos, our mobile devices have become an indispensable part of our lives. And behind the scenes, American Tower is the silent giant that makes all of this possible, making it a potentially lucrative investment for those seeking exposure to the future of telecommunications. All right, smart money investors, let's talk about dividend growth stocks. These companies share profits and increase payouts over time. Imagine a money tree that grows bigger and juicier fruit each year. That's the magic of dividend growth investing. Enjoy a growing passive income stream and the power of compounding. Invest in a company with a 3% yield, increasing 5% annually. Your annual dividend income grows, even if the stock price stays flat. It's like getting a raise from your investments every year. Rising dividends help maintain your purchasing power over time. Now, within the world of dividend growth stocks, there's an elite group of companies known as the dividend aristocrats. These are the blue bloods of the income investing world, companies that have demonstrated an unwavering commitment to their shareholders by increasing their dividends for at least 25 consecutive years. We're talking about companies that have weathered recessions, market crashes, and everything in between. Yet they've still managed to reward their investors with a steadily rising stream of dividends. Talk about consistency and reliability. Investing in dividend aristocrats is like owning a piece of corporate royalty. These are companies with strong competitive advantages, solid financials, and a proven track record of shareholder-friendly management. They're the kind of companies you can confidently hold in your portfolio for the long haul, knowing that they're committed to sharing their profits with you year after year, no matter what the market throws their way. First up on our list of dividend growth superstars, we have a household name in the healthcare industry, Johnson & Johnson. They're a global behemoth with a diversified portfolio of pharmaceutical products, medical devices, and consumer health goods. From Band-Aids and Tylenol to cutting-edge medical technologies, Johnson & Johnson's products are used by millions of people around the world every single day, making them a recession-resistant giant in the healthcare sector. But here's what makes them a dividend growth champion. They've increased their dividend for over 60 consecutive years. That's right, 6 decades of consistent dividend growth, making them a true dividend king. Their commitment to shareholder value is unwavering, and their track record speaks for itself. Johnson & Johnson is the kind of company you can buy and hold with confidence, knowing that they'll continue to reward you with a steadily rising stream of passive income for years to come. Now, let's talk about 2 more dividend growth powerhouses that are staples in households around the world: Procter & Gamble and Coca-Cola. These are companies that sell products we use every single day, making them recession-resistant giants in the consumer staples sector. Procter & Gamble is the name behind iconic brands like Tide, Crest, Gillette, and Pampers. They're like the kings and queens of household products, with a global reach and a portfolio of brands that are instantly recognizable. And then there's Coca-Cola, the beverage giant that needs no introduction. From their signature Coca-Cola drink to Sprite, Fanta, and Dasani water, they've got a beverage for every taste and occasion. Both Procter & Gamble and Coca-Cola have been increasing their dividends for over 50 consecutive years, making them dividend kings with an unwavering commitment to shareholder value. They're the kind of companies you can rely on for a steady stream of passive income year after year, decade after decade. Let's recap the 4 powerful investment strategies: ETFs, diversification made easy, index funds, low-cost market mimickers, REITs, real estate without the hassle, dividend growth stocks, income that grows over time. Patience and consistency are key. Build sustainable wealth over time, brick by brick. Pick one investment type and learn more this week. Your future self will thank you. Subscribe and hit the notification bell for more tips. Thanks for watching Smart Money Moves. Happy investing!